Check, check. All right, great. Hey, thanks everyone for coming out. We're talking about yield-bearing stablecoins. Have a bunch of really awesome panelists up here. All of them have a yield-bearing stablecoin, and we've got a lot of diversity here, which is going to be cool. So we're going to start the conversation by introducing everyone and giving you a background, giving some perspective to, giving some context to the perspective they'll be speaking from, and then we'll have everybody answer some questions about the different concerns and considerations of their flavor of stablecoin. So I'm Nate. My company is Token Dynamics. We're a protocol design firm with an emphasis on value accrual and economic security. And I'll pass it to Ameen to introduce himself, and we'll go down the line.
Hello, I'm Ameen Soleimani, co-founder of Ariah, and now Hi, which is spelled H-A-I. You can find it on letsgethigh.com. These things are called float coins, which is short for controlled peg floating stable coins. We're the ones with the weird stable coins that aren't exactly pegged to something, but they float around because they try to stabilize not only to a peg, but also their internal supply and demand dynamics. I think that's a better way to build a stable coin, but I'll let the other panelists introduce themselves too.
Yeah, I'm Nick Van Eck. I'm the CEO and co-founder of Agora. We're actually a one-to-one stable, but what we do is we have an open model where we share income with businesses, right? So I think as yields rose, people were asking, why isn't Circle or Tether paying me anything? And our view is that businesses are actually the ones that drive utility and liquidity to stablecoins. And so we engage with dApps, fintechs, exchanges, whomever, share, call it 50, 60, 70, 80% of the net income. And then they can pass that through to their users however they want, right? Whether it's building better products, having more security, passing it through to pools, buying and burning their governance token, it's up to them. But we believe that actually builders should be sharing in the income of these one-to-one fiat-backed stables.
Hello, I'm Ariah Klages-Mundt. I'm a co-founder of Gyroscope. I recently completed a PhD at the intersection of computer science and economics. Part of this PhD research was some of the earliest modeling of stablecoins like DAI back in 2018 and 2019. And this work predicted some of the major depegs that would later happen in the space, including DAI's Black Thursday and the Terra collapse. And coming out of that, I've since been turning that sort of work toward building Gyroscope, which we see as uniquely providing a uniquely resilient design and unique capital efficiencies that can come into the space. And what we think of it as basically as trying to make the safest stablecoin by making something that has a unique set of on-chain automated risk controls. And it also works in tandem with a new, more efficient liquidity pool design that we've built called ECLPs, which are able to make asymmetric concentration of liquidity and also automatically adapt to yield-bearing assets.
Thanks. My name is Matthew Commons. I'm the president of the Verified USD Foundation. It's a collaboration between Layer Zero, the leader in cross-chain messaging, and Matrixport, a major crypto financial services player out of Singapore. We're a fully reserve-backed stablecoin. Every dollar of USDV is backed by a dollar of tokenized US Treasury bills, 3 months or less. We use a unique technology called color trace that allows our minting partners, which are 8 of the top 10 DeFi providers, OTC desks, centralized exchanges. When they create USDV, we're able to track who created that and programmatically share the yield of the underlying collateral back with them. We're also the first stablecoin built using the omni-chain fungible token standard. So while all USDV is born on Ethereum mainnet, because that's where the collateral token lives, we're able to securely burn and remint that on today 8 chains, but Layer Zero actually connects to over 65 different chains, so it provides a nice growth path for us there. So yeah, looking forward to the discussion today.
So guys, my name is Pablo the Penguin, and I run a protocol called Qidao, Qidao, if it's not apparent. The stablecoin is called MAI, and basically it's a multi-chain stablecoin that you can borrow against. We're using different collaterals like ETH and other gas tokens like Matic and such. And yeah, there's a lot of multi-chain interactions that we've done with it. And it's basically in all the chains, for better or worse, as you might have heard yesterday with the phantom depeg situation that happened that we had to fix a few months ago. So fun stuff.
Great. Thanks for the intro, everyone. So a second question to kind of frame the conversation is this is the perennial question in crypto, where does the yield come from in your protocol? What we're going for is to find maybe commonalities and differences to highlight the distinct nature of each person's protocol, and then from there we'll go into more free-flowing questions. Yeah, we can start with Ameen. Just go down the list.
Well, I actually describe our yield as like farm-to-table yield. You know where the yield is coming from because it's coming from your counterparty. In a RAI system, there's like I said, it's a float coin. And so the yield is actually baked into the price of the coin itself. It's not like DAI where it's always pegged to 1. The peg itself will start to increase in value or decrease in value. So Hive, for example, launched at like $1, I don't know, 3 months ago, and now it's like $1.01. And that means 1 unit of Hive is now worth 0.01 dollars. And so where did that yield come from? It comes from the debt that is owed by the people who minted it, because now their debt is also more expensive. So when you actually play with the price of the peg itself, it's pretty obvious where the yield is coming from. You don't need to just juice it with your own governance tokens as much, or I don't know, some sort of crazy bond system like Ohm, or some unsustainable lending market yields like Terra.
Yeah, ours is very simple. It's all overnight reverse repo, short-dated U.S. Treasury bills.
Yeah, for how I like to think of this is like splitting between between organic and inorganic yield, I guess. Like some is coming from just token incentives, and some is coming from something that you actually think might be sustainable long term, something that I kind of think of as organic yield, I guess. And there's two sources of organic yield, I guess, that we built into Gyroscope. One is coming from our liquidity pool design itself, and we've built these pools to be something that we expect can eventually, or even are today, independently profitable. That they can make a yield. They don't have to only rely on token incentives, depending on the market, perhaps. But there are high volume markets where they can be profitable. And the other is coming from yield on reserve assets in a very similar way to how Maker makes a lot of its revenue generating capacity these days. The value add on top of what Maker normally is doing, but is iterating on themselves, though, to their credit, is to add a layer of risk control on top of that yield generation in the reserve-backed strategies.
Thanks. Yeah, very similar to Nick's approach. Short-term treasuries, 3 months or less, and reverse repos. The only difference is ours are tokenized, the treasuries, so we have sort of a separate collateral token called short-term treasury bill token, STBT, issued by Matrix Stock. So that's part of our model that the collateral itself is tokenized.
Well, with you're kind of the yield. So DeFi is the yield. The peg stability module that we have that maintains the stablecoin as the first line of defense for hard depegs. It's deposited into Compound or other lending protocols. On the other hand, the extra revenue that's made off of the interest, you put it through this magical box called Aerodrome, where you can basically convert your bribes from, say, $1 to $2 after a week with rewards. It's magical. It sometimes works, sometimes it doesn't, because the market can go down and you're going to be taking the other side of the reward token. But it makes a really nice way of building out systems within DeFi.
Cool. So I think this is good context for everyone, just to frame all of the other questions and how the panelists are going to answer things. And I really like Ariah's framing of the organic yield, because we've gone through a rough couple years in crypto. We've seen a lot of inorganic yield. A lot of these schemes fail. And so it's cool to have a bunch of people on stage that are building things that are sustainable and not based on Ponzi-nomics. Also seeing another sort of framing here, like there's a spectrum of yield coming from on-chain sources and off-chain sources. And so with that, maybe each of the panelists will be more free-form here. Whoever wants to chime in can. The panelists could describe, like, for your category of yield, like, who are the users and what do they want in either the off-chain source of yield stablecoin or the on-chain source of yield stablecoin? Maybe you could speak to that. Yeah, whoever wants to. Yeah, I mean, you can.
So Hi is a multi-collateral fork of Rye on Optimism. It has a bunch of different types of collateral backing it, mostly crypto collateral. So like op tokens, ETH, staked ETH. And being able to use staked ETH is nice because then people can get some yield on their collateral. They might be willing to pay a higher interest rate to borrow against that. We also have like Rye as collateral, LUSD as collateral, but we don't have is DAI or USDC or things like that, because we've seen what happens with those kinds of stablecoins. People try to juice the yield, so DAI parks a bunch of money with USDC, USDC depegs. Well, now DAI's peg is in question. And so I think it's good to have different kinds of stablecoins that expose users to different kinds of risk, right? And we don't necessarily all want to have the bank run risk where, like, is that USDC wire going to go through, and suddenly we're all like gambling on a 10% depeg. And then it drags down all the other stable coins with it, which is just funny. Like LUSD was like below peg, and it's like, this is just like an IQ test. This thing is certainly going back. Like, it's in no way backed by the banking system, which is currently failing. So just buy as much of any of the things that are not backed by banks. But yeah, those non-bank backed assets have their own risks, which is like governance attacks, smart contract bugs, and so forth. So I'm glad we live in a time with options.
Yeah, I actually maybe just want to respond to what he said is actually, right, I think what we're doing at Agora, and actually what Matthew is doing as well, is by buying securities, you don't, that are federal securities, you don't have the risk of bank runs, right? What USDC did, and their mistake, was keeping $3.5 billion at a regional bank when they had access to Boney, which they probably shouldn't have done. So I think that was a lesson for, I think, the whole industry. But a lot of people are actually doing things the right way, like Paxos. Austin Campbell's a friend of mine who's the chief risk officer there. They've really intelligently designed, I would say, their fiat-backed products. You have to keep a small portion of the assets in banks so that you have liquidity, right, if people want to repurchase your fiat coin. But I ultimately think of this whole ecosystem as like Lego blocks, right? And fiat-backed stables are, have the largest utility, but also have the greatest liquidity, and that's really important for any sort of decentralized product. My co-founder was the lead dev at Frax, and we're very close with their team. We'll be working very closely with them. And hopefully some of the other decentralized stables as being a liquidity mechanism in their PSM, or just as a buffer, right? As they think about having other CDP or higher risk assets or more volatile assets in their portfolio backing their stable. So,
cool. Yeah, good response. And we're talking about risks, so let's keep talking about the risks of various stablecoin models, and then we can talk a little bit about the user profile and like why people would want to use the particular type of stablecoin given the nature of the risks and other factors.
Yeah, I think one of the things that is like everyone would like to have a completely fungible stablecoin that can be sent without KYC and also paid interest. But that just, and is like totally safe, you're like taking US government risk. But that just doesn't really work under current securities laws if you're going to interface with a conventional system in any way. And you probably do. If you're going to hold treasuries, you have to be interfacing with the financial system to be holding the treasuries in the first place, because treasuries are securities, right? US treasuries, they pay interest. They're like explicitly a security. So if you have a token that is just kind of passing on the yield of that security, it's pretty hard to say that that isn't a security as well. So you can have other tokens that bear yield in sort of like different ways from DeFi, and maybe it's staking and whatever, and you can sort of make a case. But it's pretty hard to make a case that if you package up US Treasury yield and just pass it on to the end user without KYC, that's okay, right? That's, if you do that at small scale, maybe you can get away with it, but if you're doing it at any meaningful scale, someone's gonna come knocking on your door. So the issue then is, like, how does this all fit together? You know, US Treasury yield is a really important part of stablecoin infrastructure and architecture. I mean, I got into this space when yields were near zero, so nobody really cared, right? It was like you would go out, you'd hold Tether, you'd hold USDC, you know, depending on your preferences, and no one really cared about that. Now, with interest rates where they are now, and they're probably not going to zero, it's gonna be a meaningful part. So you have to look at a way to deal with that. And you have this inherent trade-off between you know, fungibility and you know, the requirements around securities issuance and stuff. So we've done that by separating it into two pieces, where you have the ones that actually earn the treasury yield are KYC'd. In our case, they're offshore, and we do that through a separate token. I think, you know, Nick has a similar model, but you know, the ones that are sort of earning that are kind of the partners and KYC generally, from what I understand. So there's a role for tokens that don't pay interest but are completely fungible. And then there's also roles for things that do provide yield. It may not be treasury yield, it may be something else that you're kind of backing into through a protocol or whatever, and are also fungible. But they're not kind of the same thing. And you know, there's room for all of these in the ecosystem. You know, we work with Frax as well. We're paired with them. There's other different types of things. So when you kind of look at this, these are different Lego blocks that kind of come together. We think the completely fungible, non-interest-bearing stablecoin is a really critical part. I think Tether and Circle have shown that. We think the interest-bearing, KYC, like institutional investor, treasury-backed thing is also really important. And then there's plenty of other you know, different DeFi protocols and other types of things that generate all sorts of really interesting yields, some of which might have a good risk-reward trade-off, some of which might be Ponzi-nomics, but those are out there as well. And the cool thing about DeFi is you can take these Lego blocks and put them together in ways that hopefully meet some end real-world use cases. So.
And do you see any risks associated with the centralized source of yield? You know, whether that's the nature of like short-dated treasuries and spikes in interest rates, or whether that's the you know, some of the risks that Ameen was alluding to with you know, parking your money in the bank, or you know, relying on the U.S. government to pay out on their obligations, things like that?
Yeah, I mean, there's always something with treasury risk. What if the U.S. government defaulted or something like that? I think that's going to be inherent in a lot of these things, and it's usually a time-based thing. Like maybe Congress doesn't pass a budget, and maybe they miss an interest payment or something. But you know, I think there is potentially some duration risk. I think the nice thing with where we are right now is you can do reverse repos, which are literally just overnight, and you can earn a pretty good interest rate. So that's a nice place to be. I don't think we're going to be there forever. But if you keep it pretty tight and you keep it less than 3 months and so forth, I mean, you know, worst case, if there's an extreme run on the bank, you know, maybe people, you know, have to wait a few days or something in a real stress case scenario. But it's not going to be the same type of thing as keeping billions of dollars, you know, way beyond the FDIC insurance limits at a bank. And that's what's concerning about some of these stablecoin regulations that we see coming out, including in Europe. If they're mandating stablecoin issuers have cash at banks beyond the deposit insurance limits, I don't think that's really a safe way to set things up.
Yeah, I would agree. One other thing to add is just the scalability of the banking partners. So unfortunately, you know, I think this is one of our advantages is we have access to one of the largest global custodians. They oversee over 40 trillion in assets. But most crypto startups don't have access to banks at all, or even some of these startup stablecoins. And they're using very small banks, like 100 to 250 million AUM. Those aren't like scalable stablecoin partners, right? You know, we were actually talking to MakerDAO and DAI, and you know, they looked under the hood and they said, you guys are the first centralized stable outside of USDC where we like trust your custodian. And like that's important because the people that are managing 50, 100 million, billions of dollars are going to look under the hood. And so that I actually think is a really key risk from the centralization side. But yeah, otherwise I would agree with everything Matthew said.
Cool. Haven't heard from Pablo, so if you want to chime in here.
I mean, I like the idea of these centralized stablecoins because they are kind of like wire transfers for crypto, but in general, they're good on the outside, the edge, and the entire economy within crypto does not necessarily need to have a redeemable USD right then and there. It might be a synthetic USD, it might be a synthetic BTC or anything. Basically, if you're deep in the DeFi space, you may not necessarily need to move out of it. Particularly, you're doing some apps, you're playing some games. It's okay to not actually convert it to like a USD token, which maybe carries a higher premium. But yeah, commend y'all for trying hard to get the regulators happy. I think we got like a 2 out of 5 pushing towards the DeFi.
You've got a license, Nick, right? You got your money service license?
Yeah, so we have various licenses. So we have MTLs in the US, VASP in the EU, where a lot of my life is going to be spent with regulators and getting licenses, so.
We're sorry.
I'm as well.
I would
Pablo.
add a little bit here. I'm kind of like middle ground. There's kind of like two sides here. I think one is very much like a U.S. Treasury risk, okay, and the other is preferring very much like completely on-chain kind of like assets. I think like Gyroscope also kind of falls in the middle ground. We kind of see that there are substantial risks on both sides, and probably more than like more treasury risks than would normally be the case in finance, just because it's in crypto and given like all the regulatory environment and like if it's actually being integrated into DeFi, the risks of these tokenized assets are just going to be just a bit more. I still think it's niche, don't get me wrong, and like I'm not saying anything big is going to happen, but there are risks and they should be kind of taken into account. And that's what we're trying to do with Gyroscope. Basically, take the universe of assets that exists and as it evolves, what can exist really, and try to piece together like all the different Legos, like you were saying, and try to make the most resilient structure that you can out of the different risks that are inherent in the space.
Yeah, and Gyroscope does that in a really unique way, where it's like kind of a reserve approach where you have exposure to a bunch of different currencies, and those are different stable coins. And thanks, Ameen. And those are the basis for Gyroscope's stability in a lot of ways. Can you speak a little more to that, just to give the audience some color?
Yeah. So the story kind of goes basically that Maker, back in 2020, when they had this Black Thursday event, kind of found that they needed to be able to actually maintain stability one-to-one, they needed to have something called the peg stability module. And this is kind of how they evolved after that event to actually maintain stability. And the peg stability module moved away from their original design, which was this like CDP-based system, and now commonly like actually accounts for like more than half of like the DAI supply. And the peg stability module just pegs like one-to-one with USDC, or that was the original form of it. Now it's also kind of encapsulated their like real-world asset system, et cetera. And that was kind of the motivation for what we were designing for Gyroscope is how could you build like a better PSM system, something that could help you account for the risks, build in sort of like an automated approach to monetary policy, and also importantly build in sort of protections against like oracle risks, which is also one of the things that like came to bite Maker back when USDC depegged last year. And so that's how I would describe Gyroscope, is basically if you were to build like a better PSM reserve-backed sort of system, that's what we've made with Gyroscope. And there's room for it, in Gyroscope, there's room for everything across the asset space, for the important reason that they all have different risks. And because they have different risks, you can help mitigate them through diversification.
Awesome. And Pablo, I wanted to circle back to something that you mentioned, which was the use case for centralized yield-bearing stables versus decentralized yield-bearing stables. And you were kind of touching on that. Can you elaborate a bit more? You said there are people redeeming stablecoins at the edges, but not necessarily at the center. And I thought that was a great framing. Hoping you can share more on that.
Yeah, I mean, if you look at like most DeFi native users, they're taking loans, they're moving money, they're doing things, but they, like, let's say I have a bunch of BTC and I pick whichever chain that I am comfortable with. I borrow against that. Now I can convert it. Now, if I want to convert it out of crypto, well, I can simply go to USD redeemable. But if I don't, and I don't want to go farm or do other things, play a game, buy an NFT, I don't necessarily need to go straight to a redeemable token. And so having the ability to keep the regulators at the edge where it needs to be, where you do need KYC and not embedded in the applications, is kind of a relatively important thing that we got to keep in our minds in.
And so with that, who do you think the users are of like these different types of stablecoins? And maybe everyone can speak from their perspective of like who your users are, who your and your competitors' users are. Like, why do people want to use decentralized stablecoins, yield-bearing stablecoins versus centralized yield-bearing stablecoins? Or where the yield sources are in DeFi or from traditional finance?
I think it's just people's risk preferences and what they want to do with it, right? So with one-to-one US dollar stables, they're used for payments, as quote tokens, as collateral, right? They're highly liquid. I think that's why people use them. But if you go further out on the risk spectrum and you want sort of 20%, 30% APYs, I think it's typically people that are trading or are comfortable with that risk. It's like very similar to just traditional financial markets, right? Like you have US treasuries, you have corporate bonds that are like BBB or CCC, and then you have like, really junk grade bonds, right? And then people are like, okay, I'm going to make this trade-off where I'm comfortable with the risk, right, for this yield. And I think that's how I think about sort of users, right, is a lot of the people that are looking for the really high yielding assets are people that are trading and saying, hey, like I'm really conscientious of this risk and I'm paying attention 24/7, whereas if you're just holding USDC, USDT, or AUSD, right, it's like, okay, I'll sit on that for a month and I don't need to look at it. I just know that it's going to be there, right?
Yeah, I think one thing I wanted to touch on is this idea of sort of centralized versus decentralized. And, it's not necessarily just completely black and white. I think our model is a little bit different in the sense that we're set up as a foundation. And as the foundation, we don't actually mint USDV ourselves. We provide the legal, technical, and governance framework where our partners can come in and mint and have it in their own color. So, I think there's a lot of parties that from an economic perspective, and this could be Web 2 companies, could be exchanges, could be others, would like to have their own stablecoin. We've seen Binance, have their foray into it, PayPal, others. But a lot of ones are not quite that big and don't have the scale to do that. So this idea of, well, maybe we're not going to have the scale to have our own color, to have our own stablecoin, but we could have our own color through this framework that is more decentralized. Again, the foundation model, the different types of colors, the separate governance token. So we think that there's a role for that. There's certainly roles for algorithmic stablecoins, ones that just want to stay in there. But in all of these things, you still have to think about convertibility. I mean, if you're thinking about value and you're thinking about value in terms of dollars, and there are some people who think about value in terms of BTC, and they're like, well, the market's doing what the market's doing, but one BTC is still one BTC. But most people today are still thinking about this in dollars. So if you have these ones that are free floating or doing that, you at least have to think about the interfaces and how are they going to get back to some more liquid stable coin or ultimately to fiat.
So take your money out while you can is what I get from this.
Well, you have to be able to it. Usually at some point you want to. I mean, you gave the gaming example, maybe that is one that's different. But like if you're on something that have a substantial depeg risk, users are going to take that into account.
Right. But using the idea of DeFi to kind of understand where the money transfers can go, money will go to a redeemable stablecoin at some point. But when you're looking at it from ETH prices or BTC prices, but mainly ETH because you can think about it from NFTs, you can think about it from games. A lot of that uses or is ETH denominated.
Yep.
So from there, a user doesn't necessarily have to go to a redeemable stablecoin.
Mm-hmm.
They can just go straight to ETH using the conduits of these, we can call them synthetic-ish stablecoins.
So how have you set that up? Like in terms of your pools, is it like going mainly going to ETH, or do you have pools set up with conventional stables as well for your users?
Yeah, so part of it is having a conventional stablecoin connection. I think that's usually when the market gets rough, everyone says we're going to go LP or USDC pool. But otherwise, it's much better to set up a concentrated liquidity with an ETH or some other volatile-ish asset in comparison to a stablecoin to be able to grow it more because, well, still the risk premiums or the reward premiums are pretty high, particularly in all EL2s, so it can be complex. But that's where we basically help it through the PSM, and basically the market lending on Compound helps us get better yield out of it than we would otherwise.
To build on that a little bit, I think a main idea here is a stablecoin doesn't necessarily have to have its own link out to the traditional financial system, although it is very important that there are links out to the traditional financial system. So being able to trade to USDC and convert USDC to dollars or something like USDC, I think is quite important. But for a stablecoin like Gyroscope, for instance, we don't need to have that link ourselves as long as other links exist. And actually, the liquidity of Gyroscope is actually very good. It's one of the most liquid stablecoins for its size. It has like a swap velocity that can compete with Tether, which a lot of stablecoins can't really say. And that's because of some of the unique decentralized benefits, actually. So you can have good liquidity without necessarily having your own link out, I think is one of the lessons here.
I'm curious about Ameen's thoughts on that. Ameen, do you think crypto stables need to be redeemable for dollars in some form? Or, I know you have...
Can you guys read my shirt here? See what it says? It says, abolish the Fed, replace it with a computer. Milton Friedman. He actually said that. Of course, he said you could replace the Fed, or abolish the Fed and replace it with a computer. Not necessarily you should. We tend to take the view that you should. So Vitalik wrote a fun post about this. Redeemable. Redeemable is an interesting word, right? Directly redeemable is one thing. Being able to always turn in the stablecoin for the underlying collateral. We got a B rating in Rye from the, what are the stablecoin blue chip? Blue chip, because they liked LUSD's model where it's directly redeemable. They gave them an A. But the blog post Vitalik wrote was about Terra Luna versus Rye and comparing those two. And I think he was making the argument, and I tend to agree that stablecoin systems generally should be unwindable. And what I mean by that is everybody who puts in their assets should be able to get their assets out, right? There's two categories of users: the stablecoin holders and the people who issue the stablecoins in a debt-backed system against the debt. Mint it. And something like Terra Luna collapsed because 80% of the balance sheet was Do Kwon's confidence, and so when that evaporated, everybody was left holding the bag. The simplest analogy I can make for how that system worked is I'm going to issue, as a bank, I'm going to issue a dollar note that says, when you try to redeem this, I will issue $1 worth of share of my company stock and give it to you. And if you know that that's a bunch of redemptions are coming, you're going to sell all the stock. The stock's going to zero. Nobody's holding the bag. And so it's backed by nothing, right? So that's an example of a redeemable stable coin where the redemption mechanism did not allow it to fully unwind. So that's why we tend to talk about over-collateralized stable coins. And the government of the United States actually got this right when they talked about Terra, which is they called it endogenously collateralized, basically collateralized by its own governance. And the thing that we should also remember to be honest about is that the United States dollar is about 1,000 times worse than Luna UST. It is the most endogenously collateralized system on the planet. Dollars are backed by bonds. Don't forget this. All of our we're all haha, our dollars are now backed by even more bonds. Wonderful. I think you want to take into account the unwindability of the system, not just the redeemability. And so, for Rye, the way we approach this is okay, there's an exit tax. If you're holding the stable coin and the price is below the peg, 5% below the peg, you're paying a 5% exit tax to sell it for something else. Okay, so how do we address this? Well, we're going to make the coin more expensive. We're going to give an incentive to people to come buy and hold it. How do we do that? We set a positive rate. Now, this isn't a price rate. This isn't like the units. It's the redemption rate, so it increases in value over time. A $1 peg will become a $1.02 peg if it has a 2% rate. But this incentivizes people to come in and buy it, and then you have a lower exit tax. And how do we determine the rate? Well, it's based on how far you are below the peg and how long you have been that far below the peg, which turns out as the maps to the control theory terms, proportional, integral control. There's a whole branch of mathematics devoted to this. None of you guys know it because you didn't study chemical engineering, but you should have. And so you can learn this, and that's how everything else on the planet stays stable. And you don't actually need central bankers to come out with their robes and say, the rates should be blah, You can automate the whole thing. And so RAI is a experiment in monetary policy, automating the whole thing. HI is a further experiment in monetary policy. Who are our users? Fanatics. Because it's people who either want ETH, RAI, which is backed only by ETH, so they're completely ETH maximalist, or they're willing to engage in this new experiment on optimism, and we believe HI will get higher. And so, that's our version of our yield-bearing stablecoin. So thank you.
Yeah, so it sounds like your users are those people that are thinking in BTC or ETH terms, like Matthew framed it earlier.
Yeah, our users are thinking that by the time we're finished, they're not going to call it central banking. They're just going to call it banking. Every idiot's going to be able to run their own version of this. It's going to be great. The golden age of central banking is ahead of us.
And how do you see that evolving over time? Like, how do we get from here to there?
It's like the printing press. Like you just allow people to have assets. There's 3 decisions you make when you start a central bank. And it's like, what is a reference asset? What is the accepted forms of collateral? What is the monetary policy to achieve stability with respect to the reference asset? And so if you make that whole process easier by having real-world assets, representations of those on chain, you have your shares in a REIT is like you can now get loans against basically real estate. I want like a group of high-tech farmers in the future to be able to just set up their own currency and be like, listen, all right, what are we doing? Okay, you have chickens, you have oranges, you have a cow. So now we're going to make our own basket. It's like a cow, 10 oranges, and 3 chickens. We're going to price this in gold. And then, that's our reference asset, chicken, gold, cow dollars or something. And then we have, collateral. What's collateral? Well, it's like your orange trees, his chickens, and the cow. And, I'm hand-waving over a lot of you got liquidated, give me your cow, laws that need to go into place to make this work. And then you have the monetary policy, which is like, well, if we try to exit the system, how is it going to balance our interests to let us all get out? And then it's like, well, we're going to pick 2 terms on a proportional integral controller and then run the system and never think about it again. And that's how you get there. There's an analogy in history that I find really relevant to this, and it's the guy who invented the James Watt, Watts, is credited with inventing the steam engine. He did not invent the steam engine. He invented the centrifugal governor, which is one of the first automated control systems that sat on top of the steam engine and prevented it from exploding. Because before that, you needed a team of wizards to essentially come in and be like, more coal, less coal, so keep shoveling, so it wouldn't blow up. And then after he did that, you just put this thing on it. It makes it spin faster when it spins faster when it's going too fast, and it closes the valve. And then when it slows down, it spins slower, and then it opens the valve. And so it just runs the steam engine within a range, and that's what gave us locomotion and trains. And it was so prevalent in the mimetic understanding of the 1800s people that they were when Darwin discovered predator and prey population dynamics, he's like, oh, it works like the centrifugal governor, right? So much the meme, and so yeah, simple control systems can just have profound effects. So all fiat is a scam. We're gonna live in the future, and the future is not one where we have to listen to the central bankers that they tell us how to price interest rates. We just have market-based formulas that do the same thing with no information asymmetry and no required gaslighting to operate the system. The gaslighting comes from the fact that they stand up there and they say inflation is going to be not bad. That's their job. Because if they said inflation was going to be bad,
Transitory.
it would be worse than it otherwise would be.
Transitory,
And
transitory,
so they
transitory.
have to come out there and be like, it's not going to be bad. And then you're like, oh, okay.
Yeah.
So, yeah.
Well, I don't think you necessarily need to believe that like the end of the fiat system is right around the corner to think about other types of collateral assets. I think we already are seeing a number of different gold tokens out there that are pretty interesting. Some of which are actually quite compelling. It actually makes sense relative to physical gold. They're able to absorb the storage costs and things like that. And I think all of our technologies can be applied to things beyond just pegging to the US dollar. I think most of what we're starting with here and most of what we're doing today at this conference is thinking about US dollar. Obviously there's Euro pegs, we have some South American pegs, other types of things as well. But certainly this idea of something back to different types of commodities and so forth can make sense. Or things back to BTC and ETH. We could see synthetic BTC, synthetic ETH, different types of things that are there, and I think we'll see that evolve in the future.
Yeah, the biggest risk is the U.S. federal government coming after you. That's it. No, I'm serious. If you start like a commodity-backed currency that actually starts to pick up adoption, like the U.S. government's going to pay attention to that, right? I think that's actually the biggest risk. It's like, why hasn't Tether really leaned into the gold-backed stable before? I would imagine that's probably a component of it, right? And so sometimes you have to operate within the confines of the world that we exist in. But I do think it's important to start pushing boundaries and testing new types of mechanisms and collateral.
When the U.S. government in 1971 ended gold redemptions, if a DeFi protocol did the same thing, we would call it a rug pull. It's just straight theft. I think we should also keep that in mind when we think about the U.S. government's wishes. Ideally, I want to create commodity-backed stablecoins for like me and my friends to use, but not get accused of like supporting China and like Iran and their currency war against America. Just like because I personally don't feel like paying the seigniorage cost of like holding dollars in a bank or something. That'd be cool.
Why would? Sorry, Matthew, you go.
Oh, I was just going to say, we did have this period, we kind of talked about it a little bit yesterday, this 30-year period from 1837 to 1866 when there was no Fed. Andrew Jackson let the Fed expire and threw its president in jail. And we had 30 years in the U.S. of private banking, and the only currencies were, the only federal currencies were gold dollars and silver dollars and 8,000 different private notes. So it is possible to run an economy like that. Again, you don't have to believe that it's right around the corner, but 10, 20 years from now, people might be looking at that a little more seriously. So.
And when there is a proliferation of currencies, I'm curious to hear from Ameen and Matthew on this. Ameen, do you worry that the economies of scale are going to be hard to achieve for these currencies, particularly given that many of them are immutable, like Rye, and so you're trying one experiment after another and hoping that one of them sticks? Is there any concern in your mind that the fragmentation associated with the proliferation of currencies will prevent their adoption?
Yeah, I think that's a fair point. And I think, Tether is like the biggest stablecoin, most successful. Everybody, use it, unified liquidity across lots of exchanges. I think that's a good business for people who want to have dollars backed by, bank money. And I think I'm more interested not necessarily in the one big stablecoin to rule them all vision of the future, but like the creating economic resilience through a bunch of people able to make their own stable units of value backed by collateral, and then also them have the tools to determine the destiny of the system, right? Like, choosing their own monetary policy for like me and my friends is a thing that I think is pretty weird to us today, but like won't be as weird in the future. And so I'm more interested in the like educating people and having an example system. Like in the beginning, people asked us, oh, hey, like Rye, how does it work? What does it mean to like have a peg that floats, right? But now I just show them the chart of like Rye relative to like all other dollar stable coins over the last 3 years. And I'm like, we don't have any meetings, but like our interest rates make the peg like largely keep pace with all of the other foreign currencies on the planet. So like, you can sort of prove the system works. And I think that's been an important part of the journey. Not everybody is going to, it's almost like our users are not necessarily like the stablecoin users, but people who are also interested in this vision of creating their own currency and automating the monetary policy. So.
Yeah, that makes sense. Matthew, I'm curious on your answer to that. How would you see the fragmentation of currencies playing out, maybe with the historical context of the free banking period in the US?
Yeah, sure. I think a couple things. I mean, there was a lot of information that needed to be shared, right? You had like 8,000 different currencies, so you had these periodicals, Thompson's Banknote Review, that would come out twice a week, and you'd have to be like, oh, well, which banks went bust? Which ones are traded at a discount? But there was a lot of cross-holdings between banks. They had their own networks there. And in some cases, there was mandatory redeemability. So in New York, every single bank had to have a relationship with a larger bank in Albany or New York that would redeem their notes for gold. So that was really critical to making the system work and establishing New York as the financial capital at the time. So redeemability and having some way to exit, like I have this piece of paper, I have this coin, like how am I going to get out into the reference asset? And having a clear way to do that, whether it's directly or through some type of a network relationship, is important. Because people don't want to like do their homework. They don't want to have to. I think there's definitely a class of people that like want to just go from the chemistry lab into the financial lab and actually work on setting their own interest rates and things like that. And then other people are just like, what is this token worth? Like, can I get out of it if I need to get out of it? And you need to really have these shortcuts available for those classes of people.
Yeah, but then like USDC depegs, and we're all like, oh, what banks do they use? How much money is in each of those banks? And we all have to do our homework
point,
again.
yeah.
So like,
that was a circle problem. They didn't manage their assets appropriately.
right. So a principal at your firm is getting investigated by the government, and they decided to close your securities swap account. Is like another risk. They could come after you personally, right? Like
100%. That's what I was saying earlier, right? The biggest risk of like starting these stable coins with different collateral backing it is actually the U.S. federal government and them coming after you, right? Like just because you're decentralized, like there's people behind these decentralized products, right? So I think
bring back Thompson's Banknote Review, resurrect it from 1866, and be like the stablecoin review twice a week. Like, okay, who's getting investigated? Who's depegging? Whatever.
Yeah, but there's a difference between like closing someone's exchange account or like bank account and like turning off their smart contracts. Like, how are you going to turn off the smart contracts if they're immutable or something?
Yeah, I mean, you can turn off smart contracts if they're mutable and censorship resistant, but you can go after the people that are actually creating the smart contracts.
Yeah, so my friends are facing prison time for Tornado Cash. It still works. Like, it actually has more ETH in it than in the month after it got sanctioned. I'm gonna die, and that shit's still gonna work. So like, what are we supposed to do about this? Like throw Ethereum in jail for?
I don't think you'd be
tried
playing
it.
Yeah.
They gave him a pass. They said it's not a security, even ETH 2.0. So they might come back, though. We'll see.
Well, Ameen, do you see a chilling effect coming into play for stablecoin developers the same way we've seen with privacy protocols?
It could. Yeah, certainly. We have been lucky and fortunate so far that like major terrorist organizations have not really used the stablecoins as much as they could have. And I think that if they did use them a lot more, then we would have to either like develop capabilities to keep them out, or otherwise, find better legal jurisdictions, or like Michael Mosier wrote a paper about like credibly neutral decentralized finance, and how like maybe it should have a different legal classification than being treated as like a bank. And the idea is that like every bank is a mixer by default. So the reason that you need the like Bank Secrecy Act is to go look inside of every bank and see what it's doing. Whereas like DeFi operates pretty transparently, and so it's not actually hiding anybody's financial trail. You can see the inputs and outputs pretty clearly, and so maybe it deserves a different classification. This
is actually like a great point, right? There was a debate a few months ago because some people in the U.S. federal government were like, 1% of Hamas financing was coming from stablecoins. It's like, all right, well, where was the other 99% coming from? It's like we knew that it was this, and we can freeze it, right? That's actually useful, right? And so, like, I think he makes a great point. Like, that's also probably why they won't use stablecoins going forward, because you can see everyone's financial history on chain, and ultimately there's probably some sort of KYC linking that back at somewhere, right? Even if it's 150 transactions later.
Or even if it's like several years in the future that it gets traced.
Great. So looping this back around a little bit to yield-bearing stablecoins, why do you guys think there's been an uptick in the last few years for yield-bearing, well, in the last year really, for yield-bearing stablecoins in particular? Like, what is prompting this?
Federal Reserve interest rates are now not zero.
Yeah, the cost of capital has gone up.
Also, their tax advantage, there are more tax advantages for Americans, mostly Americans, because you have assets that you may want to farm with, and you want to go play the different games, whether it's like Frax or Aerodrome or Linux or whatever. There's a bunch of opportunities, but you don't want to take the risk of having to go spend some cash, and then claim, and then go explain to your accountant, well, I just bribed on this protocol, and they gave me this other token that I got back, but then it dumped 50%. But technically, the cost of capital was the bribe that I did, which was 5K, but then I only got 2K, and then I had to sell it for ETH, but then the bridge got hacked. There's a lot of questions. But some cool protocols out there have been like Overnight Finance and others like that, where they basically automate these strategies for the end user. And that tax advantages, the tax advantages from yield bearing as a staking mechanism is very useful for the end user.
And I think a bigger point beyond that is just the technology's gotten better, right? So, it's not just, hey, there's yield and you're going to pass it through, but there's all kinds of, things under the hood with algorithmic stablecoins, with color trace, with other types of things that, you can have fungible stablecoins and also be able to do something thoughtful with the yield, that isn't, prima facie, breaking securities laws. So.
Yeah, I also think there's net new innovation, right? That's cool, right? If you go to the traditional fixed income market, your source of yield is either the federal government or corporates, largely speaking. Whereas like in crypto, people are experimenting with things like, taking the sequencing revenue and packaging that as yield, obviously staking. And so like there's net new forms of yield that are interesting for the first time in a long time. So I think that's also what's bringing people into the space.
And do you guys think it's primarily driven, I'm hearing two answers. It's, the cost of capital and the risk-free rate from traditional finance, and then also the opportunities in DeFi. Do you guys think it's primarily driven by the opportunity cost in, where degens can get 15, 20, 30% otherwise, or because interest rates are going up, like Ameen suggested?
I think that there's a lot of people that want to keep their money within the crypto space. It's something like a lot of the new users, we can call them, or the new employees that go work at a new company in crypto, they get 5, 10K in a MetaMask, they switch it to a ledger, and they're happy with keeping it there rather than deciding to go to Coinbase and then take one risk and then move it to Robinhood and go start trading. They don't feel like they want to go all the way there. And so because they keep it in the crypto or just on the blockchains, they basically provide yield, whether they're borrowing things or they're swapping, and that ecosystem will still grow. Like, it's basically the everyman's Swiss bank account.
I think it's also partly that this is how new stablecoins can compete with USDC and USDT. USDC and USDT earn the same sort of yields in the background, but they keep it for themselves. And a competitive advantage would be sharing it with the people who hold your tokens. And that resonates quite a lot with some users. And also another group that hasn't really been mentioned yet, but is, I think, a big traditional holder of USDC is just other protocols. And if you can do actual revenue share with the protocols that end up holding a lot of your tokens, that's a lot more compelling with them to integrate your token as opposed to USDC and USDT.
Yeah, this is what we're doing, right? It's like we're a 1-to-1 fiat-backed stable. We share the majority of the net income with these businesses or chain partners. So our view is they're the ones that are driving utility and liquidity to your asset. And I think that's resonated with a lot of folks. I think one other point you didn't mention is that Circle shares half of their off-platform income with Coinbase. So there's $2 billion of USDC on Solana. Right now, Coinbase is making almost $1 million a week off that USDC. Well, now they also have their own chain base. So there's a huge conflict of interest with USDC across like all crypto stakeholders now, because you have Coinbase, which has the wallet, the exchange, the prime broker, custodian, the chain. And so if you're using USDC, you're funding Coinbase. And in most cases, that's people's biggest competitor. And so I think there's an opportunity for a net neutral money like us to come in and also distribute a lot of this value back to the businesses and these protocol operators, which is what we're trying to do.
Do you think USDC is going to turn into a yield-bearing stablecoin given all this competition?
No.
Why not?
We can just launch a yield-bearing product, right? It's like USDL. Paxos launched USDL a few weeks ago. The issue with having a yield-bearing product that's centralized is that you limit yourself to a much smaller market and a utility set. So they came out and said, hey, USDL is live, but if you are an American, Canadian, UK, EU, Hong Kong, Singapore, Japanese entity, you can't touch it. That's
North Korea, Iran.
Yeah, it's like 70% of global capital markets. So not only can you not touch those users, but you can't touch the vendors, right? And businesses that operate there, whether they're like applications that are entities that are set up there or market makers like Cumberland or Wintermute. And that deprives you of a lot of utility and also liquidity. So I think those models, at least on the centralized side, are going to be challenged until some laws change.
I think everybody just needs to create their own like Cayman and BVI and offshore sub, and then we'll just have those transact with each other. And
yeah, decentralized yield-bearing stables, I think, are a better solution than centralized ones.
Why?
For everything I just mentioned.
Yeah, I mean, at the end of the day, do you want crypto to become like email, or do you want crypto to be what it is today? Because today you can have your own wallet and you can send money to whoever you want here. But emails, well, they kind of got co-opted. The SMTP protocol or SMT protocol. Like, it's now if you want to create your own email and you want to run your own server, you can't. I mean, you could, but like you're probably gonna pick up with the wrong IP address because so many IP addresses are banned because so much spam. So then you have to choose a service provider, usually Gmail, and then you can actually interact in the email space. And so we gotta be careful about that for crypto, so that we don't create too many walled gardens.
one thing just to add on there, I mean, I think there is some kind of a trade-off. I don't think that there's going to be this perfect stable coin that like is completely fungible and has yield and everything else. It may end up just be like checking and savings account, that you can kind of try to have something that's pretty efficient where you can kind of sweep into something that's yield bearing, and then when you need to transact, then you're transacting with things that are not yield bearing. And just trying to be sort of as tight and efficient as possible, that is important, because even if it's just literally overnight repos, they're still at least overnight. There is still some time value of money that is required to generate that yield, and you can't just necessarily completely eliminate that, or at least at the margin. So a few things to think about there. But yeah, a lot of good food for thought as we move ahead here.
Yeah, I appreciate everyone joining today. Really quick from everybody, where can people find you?
Ameen Sol on Twitter, AMEENSOL, or letsgethigh.com, HAI. Let's get HAI.
Nick _Van _Eck on Twitter, and then Agora.finance on the web.
Yeah, on Twitter, Aklamun, AKLAMUN.
Just go to usdv.money, and then you can see the other links from there. So.
Farcaster, Publu, Publu, and my.finance, mai.finance.
Awesome. Thanks, everybody.